So we have two experts with us today, Dan Mayo and Brian Lovett. Dan is your title is what exactly, Dan? You are national tax policy, something or other these days.
Close enough. National Tax Group.
National Tax Group Policy Director, and Brian Lovett, who is our tax team leader for real estate. So welcome to the two of them. Welcome to those of you who are on the call and on camera. I'll ask that if you're not speaking, if you could mute yourself. During the call today, we're going to have a couple polling questions. So if you want to participate in the polling questions, here's what you need to do. You can take your phone. You could also do it on your computer. It might be easier to just do it on your phone next to you. And if you go to the website menti.com, which is menti.com. And once you're in Menti, there's a 8-digit code that you can put in. And then when we ask the polling questions, those will come up and you can just answer, and you'll get to see on screen kind of what the polling answers are. So again, it's menti.com. And the code, which Alex will also put in the chat, is 5700-6990. 5700-6990. So you can answer the questions along and kind of see what the group is thinking and and what their interests are in some of the topics that we have today. So we're going to be talking about 6 different things. We're going to talk about 1031 exchanges, capital gains, the net investment income tax, EBL, carried interest, and step up. So again, menti.com, 5700-6990. During the call today, you are more than welcome to put questions into the chat. I will direct those questions to Dan and Brian as they come in if I can. In addition, if you would like to ask a question, you are welcome to raise your hand, and I will let you know that you can unmute yourself. If you're on the phone and you need to unmute, it's *6, and then to remute yourself again, it's *6. So any questions, please feel free to put them in the chat. So I think we'll get started with our first topic, which is 1031 exchanges. So we do have a polling question prior to that. So Alex, do you want to share your screen for the polling question?
Yes.
Yeah.
So our first polling question is, for the business that you're in, how many 1031 exchanges, like-kind exchanges, have you done for your business? Have you done 0, 1 to 3, 3 to 5, or more than 5? I'll give you about 15 seconds or so to answer before we close the poll. All right. So I'm not sure how many people have answered, but of those that have answered, about half of you have done none, half of you have done a few, and a little more of you have done more than a few. So Brian, you want to talk to us about 1031 exchanges and what the proposal means, and maybe what the legislative update could be?
Sure. Thank you very much, Rebecca, and thank you everyone for your time this afternoon. I know there's a lot of interest in these proposals, and this happens to be, I think, the elimination or limitation on Section 1031 exchanges happens to be probably one of the ones you read most about in the news, especially as it relates to the real estate industry. So it did seem like there was a good sample size, and there was a number of folks who haven't done any 1031 exchanges. So just to, level set a little, make sure we're all talking from the same space. Obviously, Section 1031 allows for tax-free exchange of like-kind property. It used to apply to a whole host of transactions: a boat, a car, a truck used in a trade or business, an MRI machine used by a doctor. The Tax Cuts and Jobs Act of 2017 pretty substantially cut that back, and it limited exchanges to solely real property. There's been some guidance after the TCJA that provided the definition of real property and how you know when something is real property, or how you know when it's personal property tied to real estate. But for purposes of our discussion, understand that the 1031 exchange process used to apply to just about anything, any asset used in your trade or business or held for investment, and that was cut back pretty substantially in 2017 for tax years beginning after 1/1/2018. This is traditionally every time there's a discussion of tax law changes and budget proposals, 1031 is usually on the radar. 1031 and then carried interest that we're going to talk about later are the hot topics that they like to talk about because there's a feeling that they provide a pretty nice tax preference to a very limited number of people. After the carve out, of real estate when they changed the 1031 rules in 2017, it's not surprising to see this on the list as a potential revenue raiser for the Biden tax proposal. So what their proposal would do is not eliminate 1031s entirely. It would limit the non-recognition piece to $500,000, $500,000 per taxpayer, and that would be $1 million if you have a married couple filing a joint return. So it's not a complete elimination, but again, for some of these big real estate transactions, and for those of you who've done 1 to 3, even 3 to 5, obviously it seems like this is a big part of your real estate investment strategy. And it would substantially cut back on your ability to use 1031 to not recognize your gain and roll your gain into the next property that you're acquiring in your exchange. And Dan's going to talk later about the elimination of stepped up basis. Those two things put together are huge impact for real estate, because what you used to see is exchange, just keep going to exchange until there's a death, and at that point everything steps up and all that deferred gain just gets completely eliminated. Now we're seeing a little bit of a step back and the need to recognize income on the exchange. So a couple particulars to keep in mind. The way that the proposal is written, it's a $500,000 per taxpayer per year limitation. You cannot recognize 500,000. Anything over 500,000 would need to be recognized. Traditionally, with Section 1031, the definition of the taxpayer is, if you hold that real estate in a partnership, the definition of the taxpayer for 1031 purposes is the partnership. So, interesting question to follow as they develop this. If that is the case, that would mean a partnership doing an exchange can only not recognize up to 500,000 for that year. Anything over and above that would seem to need to be recognized at the partnership level. But again, that's going to be definitely something to keep our eye on as far as how the $500,000 limit is applied to a taxpayer if it continues down the road of proposal and legislation. The gain that has to be recognized. So say you sell for $3 million gain. We know we can exclude 500,000. There's $2.5 million that has to be recognized. The gain in excess of that stated amount is taxable in the year in which the taxpayer transfers that property. So that's going to be important when your exchange straddles 2 years. For those familiar with 1031, you actually have 6 months to invest in that replacement property. So if you sell in October, you sell in November, the replacement could very well happen after January 1st into the next tax year. Under current law, you can use the installment method. If your exchange blows up under the current law and you have to recognize gain, you can use the installment method to defer that gain from year 1 into year 2 when you actually collect your proceeds or you get your boot that would then be taxable. Based on the language in the proposal, you can't do that with this new proposal. The gain's going to be recognized back into the year where you transferred the property subject to the exchange. That is going to put some substantial pressure on people who are doing 2021 exchange. As there's uncertainty out there, some substantial pressure on people doing 2021 exchanges now to try to get that exchange completed before the end of the year. So, right now you'd have your 180 days, you'd still expire this year. But the law is effective for tax years beginning, the way it's written is for exchanges completed in tax years beginning after 12/31/2021. So if you were to sell on September 1st and complete your exchange on January 15th of 2022, you are going to, that exchange would now be limited. You would be able to not to use the $500,000 and not recognize that amount of gain, but anything over that gain would have to be recognized and could impact your 2021 tax year, because that's going to, when it under the law would go back to 2021 when you relinquish the property. So there could be some substantial pressure on exchanges in the second half of this year to get them finished in 2021 as this proposal carries forward. If you've read about this proposal, I'm sure you've seen there is a substantial concern that it's going to, I think a few of the things I've read, it's going to cripple the real estate industry, that it's going to put a restraint on deal flow. It's going to encourage people to maybe not recognize their gains, hold on to their properties, and explore other alternatives. And we're going to talk about those alternatives in a minute, but potentially explore other alternatives to either defer the tax or somehow leverage the property, put your hands on some cash without recognizing that gain. You know, this provision, coupled with what Dan's going to talk about in a little while with the potential for increased tax rates, it also leaves people in some pretty uncertain area if you're looking at doing a sale, and you may have to recognize some gain now because you're not sure exactly what those tax rates are going to be. The other concern is it may limit the ability of taxpayers, developers who may want to get their hands on some property and convert it and use it to its highest and best use. They may not be able to get their hands on property. So I know that there's a substantial concern about a reduction in deal flow, in how many people may not sell if they can't utilize 1031s. There's also a lot of ancillary industries out there that are completely or largely propped up on 1031 deals, things like tenants in common, where you can sell a piece of real property and buy a TIC interest. And those TIC interests are designed to be parsed out, you know, and largely marketed towards 1031 investors. Makes it a lot easier to sell your property, buy into something that would provide a little bit more of a return without the active management requirement of a potential wholly owned piece of real estate. It's a very popular market, and it may be substantially impacted by this change. So that's the change in a nutshell. Do want to spend a couple minutes really quickly and talk about other opportunities that would exist. Obviously, if 1031 goes away, it's going to take some planning to figure out how can I what are my options if I'm looking to get rid of one piece of property, maybe get my hands on another piece of property or share in the benefits economically of another piece of property. What can I do if I don't have the ability to sell my property, defer all my gain, and get my hands on new property? I think one thing you might see to work around the $500,000 limitation, and this is going to be interesting to follow as the legislation develops, you may see partnerships start to break things out into TICs or condominiums or series LLCs or things like that that would allow for an increase in the number of transactions, right? Break bigger deals into smaller transactions where you can, you know, effectively convert your partnership holding into a tenants in common holding, have everybody own their individual shares of the real estate in tenants in common. And then if they sell their individual sales of the real estate, you would be able to exclude that $500,000 to $1 million of gain on those personal tax returns.
No, you don't have to stop at all.
Whether they're separate
I think that
or joint
the two
returns.
big questions are all on Tom's
The other
plate.
interesting thing would be to look at the potential for mixing bowl partnership transactions. Those are transactions at a very high level where property is contributed to a partnership. Other parties contribute property to a partnership. After the required 7-year window, you can then take a distribution of a different property than you contributed from that partnership. So during the period of that 7-year operation, you're sharing in the economics of multiple properties. You're getting a little bit of a diversification of your real estate holding. And then at the end, you can walk away with something different. You also may see more in the leverage partnership transactions where you go out and leverage up your piece of property, distribute that cash under current tax laws. You can then distribute that cash out and then use that to invest in other properties. So you're lowering your exposure to one particular property, moving that equity over to a different property. And also, you could see an increase in UPREIT transactions where you work with a public REIT and you do unit deals where you would contribute your property to a partnership in exchange for interests in this partnership interest that would down the road be convertible into REIT stock, would be tax deferred for now, but then would have that trigger of tax when you convert to that REIT stock. So there are alternatives out there. It's going to take some creative planning. If this proposal does go through, it would require taxpayers to kind of be out in front of, I want to distribute this. What is the tax impact going to be? And is there a way to work around that tax benefit or that tax obligation? Because it's not going to be as easy as calling the 1031 exchange agent, getting them involved in the transaction and going ahead and just buying a new piece of property. Obviously, for smaller deals, that may be fine. The expected revenue impact of this is about $8 billion or $8.5 billion over a 5-year period starting in 2022, and it jumps up to about $19.5 billion over a 10-year period. So as they look to raise revenue, obviously that's a pretty big number. But again, I remain skeptical cautiously optimistic that that this will fall out before any kind of final legislation is enacted. But it's on the table. It's always on the table, and it's always talked about. So it's certainly worth keeping your eye on, especially for those of you who seem to do these more regularly in the operation of your trader business. That's what I got, Rebecca.
Yeah, Brian,
Right,
this
thanks.
is like the step up in basis. The estate planners will tell you, that there's no chance that's going to pass, and it's just you don't have the political will. And I think 1031, is it like one of those things where you think it's remote, or?
I would consider it remote. I mean, I think what you've seen over the last few years through TCJA and everything else is that there's a pretty strong lobby out there, and there's a lot of folks that have vested interest in 1031 remaining in the code. I mean, there's even, if you just Google it and read around, there's a lot, not just from real estate industry, but even from the farming industry and from a lot of these other industries where maybe it's not on the radar, because when we think of 1031 right now, we think of, the retail property, the commercial property that somebody's going to sell and buy something different. But 1031 is used all throughout this country, even in the Midwest on farmland, where they're selling one piece of property and buying into something different. And they use the 1031 exchange as a way that they can do that in a tax deferred way. And so again, the limitation, I think, is much more than real estate. I think it's remote, but because it always comes up, I think it makes sense to keep an eye on it.
Yeah.
Thank you, Brian. Yeah, a lot of good information and some options to look at if this does actually go through. But it is probably the single biggest conversation I have with all the real estate clients that I speak to, is what's going to happen with 1031 exchanges. So to be determined. So again, if we're going to have a couple polling questions, so if you just signed on, you can go to menti.com, MENTI.com, and then there will be a code that you can enter, which is 5700. 6990 if you want to participate in the couple polling questions that we have. So Brian, there weren't any other questions in the chat, so we'll move on, and we'll have Dan talk about capital gains rates and tax rates and what we think or what could potentially happen. So Dan?
Great, thanks. And as with all these proposals, the Democrats have a very slim majority in the House. They have no majority in the Senate. They need the vice president to cast a tie-breaking vote there. So they do need sign off from their entire party in the Senate. So a lot of these things, they've already received pushback from some of the Democratic senators. So there will be legislation. The question is, what is it, and how watered down will it be from these initial proposals? So just very briefly, since we're going to touch on it in a moment, the individual tax rates are also scheduled to go up besides capital gain. They're scheduled to, if the proposal passes in its current form, they would go from 37 to a max rate of 39.6, which is what they were before the TCJA was enacted in December of 2017. So to give you a sense, for 2022, that highest rate would kick in for joint filers, married filing jointly, over around $509,000 of income, and for single filers around $452,000 of income. So then when you get to capital gain and qualified dividend income, so QDI, right, these are dividends from C Corp, you have the current rate is maximum 20% rate plus the net investment income tax, 3.8%. That's for long-term capital gain, right? Gain held more than 1 year. What the Biden administration is proposing is to say that if you have income over $1 million, and so married filing jointly, income over $1 million, that capital gain, that long-term capital gain or qualified dividend income would be taxed at ordinary income rates. So, that itself is a dramatic proposal. But the other piece of this that really gets a lot of people upset is the retroactivity piece of it. And so Biden has proposed to make this provision retroactive either to April 28th or May 28th. I mean, really, I suppose there are some people, there are some people caught in that month, but it's not clear what the retroactive date is. They want to do this to prevent a race to sell assets. The capital gain is something you have the ability to control. But we do have to remember that only Congress can set the effective date. The Biden administration can recommend what it wants, but Only Congress can set the the date and make it retroactive. Is that likely to happen? Who knows? I mean, we have a lot of people who wanted to engage in planning that can no longer do it because of the retroactive piece. It's possible that goes away, the retroactive part. So there will be opportunities to plan around this, in the next 6 months. But we have to wait and see. An interesting piece is when they talk, the Green Book talks about the rate, and they say it's subject to ordinary income rates. It says that the rate will be 37%, which is the current rate, not the higher 39.6. So when you look at the 37% plus the 3.8% net investment income tax, you get a 40.8% federal rate, not counting state tax. But then in a footnote, the Green Book says that the rate is scheduled to increase, right? The individual rate, which is why I mentioned it a moment earlier. It's scheduled to go up to 39.6. So what we think that means, and it's not entirely clear, but reading between the lines, we think that means that if you have gain that's recognized in 2021 and subject to that ordinary income tax, that it will be subject to the 37% rate in 2021 plus a net investment income tax, but that gain in 2022 will be subject to the higher rate of 39.6. But the individual rate increase is not at least proposed now to be retroactive. So we think that's what they're trying to get at in the Green Book. They could have certainly made it explicit, but they didn't. So if you sell something or have sold something, since April 28th or May 28th, depending on the effective date, we think it'll be, and it's treated as ordinary income. It likely will be at the 37% rate, current rates this year, plus a net investment income tax. The last thing I'll mention about this, it's not a cliff effect. So it will just be the excess over $1 million that's subject to ordinary income rates. So there is some planning here if you can, reduce your income. So I'll just give you a quick example. If you have a taxpayer that has $1.5 million of income, including capital gain of $600,000, $100,000 would be taxed at long-term capital gain rates. So the 20%, 20% rate. And then the excess, the 500 over the million, would be taxed at the 37% in 2021 or 39.6 in 2022. So that's the way it works. It's not a cliff effect, and it, obviously a significant proposal. We had many clients who were thinking about planning. I would say keep those plans, on the back burner for now. There probably will be an opportunity. It's not likely that the retroactive piece is enacted, but we'll have to wait and see.
All right, thank you, Dan. And Dan did allude a little bit to the NIIT, which is the net investment income tax, which Brian's going to talk a little bit about now. And we do have a polling question, though, before that. Alex, if you want to put that up on screen. Again, she put in the chat function, menti.com, and the code number if you want to participate in the poll. The question is, do you utilize real estate professional status in your tax filings? Are you considered a real estate professional? Give it about 15 seconds before we close the poll. Looks like right now we have more real estate professionals than not on this call.
All right.
And holding it about 2/3-ish, a little less than 2/3 to 1/3. So Brian, let's talk about net investment income tax.
Yeah, thank you. So I wanted to get a gauge for how many people, or at least what percentage of our audience, this provision that's, I'll call it buried. And I only say buried because I don't think this has gotten nearly enough publicity or coverage within the proposal as other things. And I think this has some pretty broad reach. And I think it's a silent killer, right? It's secret and you don't even know it's there. And all of a sudden you're going to be paying higher taxes and you're not going to understand why. You read about the 1031s, you read about the new capital gains rate at, close to potentially 40%. But you don't read about this additional net investment income tax. So the proposals, look to change what have for years been looked at as a few gaps in the tax law. And it looks at two things together, and it looks at the net investment income tax and the self-employment tax. Now, rental real estate income is exempt from the self-employment tax under the code section 1402A1. So if you have a rental property and you're active in that business, that trade or business, and you're managing it on a day-to-day basis and it generates net rental income, under the code, that income is not subject to the self-employment tax. The real estate professional qualification.
Wait, Brian, I'm sorry, can I interrupt you for 1 minute? We're getting a lot of echo.
Yeah,
Rebecca, can you mute everybody, then Brian can unmute?
Yeah, thanks, Dan, because that was trying to talk through that was.
Yeah, you're good now. Thanks.
All right, good now. All right, here we go. So under current law, real estate professionals, so the theory of net investment income tax is what it's designed to do is then take your passive income and subject that passive income to this additional 3.8% tax. The self-employment rules are designed to, if you are active in a trade or business, if you're a limited, if you're a partner in a partnership, if you're earning wages, if you're a sole proprietor, your income is all subject to self-employment tax. There's a little bit of a hole there because under current law, limited partners, LLC members, it's very unclear with LLC members, they kind of fit in the middle, but limited partners and S Corp shareholders are not subject to the self-employment tax on their distributive share, just on any wages for the self-employment, wages for the S Corp shareholder or guarantee payments for any limited partners. Again, the NIT, the net investment income tax, designed to catch your passive income, things like your rental real estate stream, your interest, your dividends, your capital gains, and attach another 3.8%, effectively a Medicare surtax, onto those earnings. For real estate professionals, there's a nice little carve out that says, hey, to the extent that you're materially participating in this real estate, you qualify as a real estate professional, you're materially participating in the real estate, any pass-through rental income from that trade or business is not subject to the 3.8% tax. So you can now have real estate income that is not subject to the self-employment tax rules based on the provisions of Section 1402, and then is also exempt from the 3.8% net investment income tax under the provisions of Section 1411, which say if you're, you have a carve out there, so you're not paying it. The proposal included in Biden's tax plan tries to or works to try to close a lot of these loopholes for taxpayers looking at income over $400,000. So that's their threshold for this proposal. With respect to the net investment income tax, what it does is it takes taxpayers who have an adjusted gross income in excess of $400,000. So again, keep in mind, this is your adjusted gross income on your personal tax return, not $400,000 of pass-through income from your real estate or from your trades or businesses. It's all your income taken together. If you have an AGI in excess of $400,000, what they want to do is redefine net investment income for this purpose to include all of your gross income or gain from a trade or business, as long as that income or gain is not subject to self-employment tax. Okay, so as I said before, rental income is never subject to self-employment tax under Section 1402. So now, if you have an AGI in excess of $400,000, and you have pass-through income from real estate that's not otherwise subject to self-employment tax. If you have gain from the sale of real estate, so as a real estate professional, you sell a property inside a partnership, you're allocated a share of that gain. Under the provisions of Section 1411 for the net investment income tax as it exists right now, you can even exclude your share of that gain from the 3.8% Medicare tax, the surtax, to the extent, you're a real estate professional that was sold in the ordinary course of a trade or business, that gain would not be subject to the tax. Under the proposal, all of that gain would now not only be subject to your regular income taxes, potentially at higher rates, as Dan just talked about, but also subject to that 3.8%. So if they enact this provision is going to capture real estate professionals that have income of that in excess of that 400,000, and it's going to subject all your income and gain from those trades or businesses to this additional 3.8% tax. That's the real takeaway for real estate. However, I know a lot of the real estate folks on this call probably also have ancillary businesses, management companies, construction companies, where they may be structured in LLCs, they may be structured in S Corps. The other side of this provision deals with the self-employment tax. And it puts a complicated calculation in play, and so I won't get into all the details of the calculation. But what it is going to do for those ancillary trades or businesses is take any of your limited partners, any of your LLC members who are active in the trade or business, but may not be subjecting that pass-through distributive share income to self-employment tax. And to the extent that they have self-employment income now over $400,000, it's going to start to assess self-employment tax against those distributive shares, those pass-through amounts. So the law is really designed to hit those limited partners, those S Corp shareholders, those LLC members that are active in the businesses but are not subjecting their allocable share to self-employment tax, and grab self-employment tax on those numbers. And that I've read a little bit about. But one thing that I think is really important for the folks on this call, especially since 65% or so of the people that answered the poll are using that real estate professional tax status. If your income is over $400,000, if your AGI is over $400,000, you're no longer going to be able to exclude your pass-through income from your real estate from the net investment income tax. And that's going to include not just the annual income, but any gain on dispositions of property. So I think this is it's a hidden provision in there. I have not seen a lot of discussion about it, but I do think there's an awful lot out there that we should be aware of, and you should be talking to people to make sure that we're watching this and trying to manage your income accordingly. If you can if you can take advantage of things like installment sales, take back paper, manage your AGI to keep it less than that $400,000 threshold, there may be ways to work around this provision. But if not, this provision is going to kick in to add an additional 3.8% to all of that income that right now is not subject to it. So that's the big takeaway there.
Yep. Not a great outlook for the real estate industry from that perspective. So Dan is going to talk to us a little bit about, I mentioned before, EBL, excess business losses. So Dan?
Yeah, so this is a provision 461L for people who care about those code sections that came in as part of the Tax Cuts and Jobs Act. What it does is it limits the pass-through of losses from a S Corp or LLC limits the losses in excess of $500,000. And so it caps you at the amount. The excess can be carried forward into future years. But it was scheduled to sunset or expire for taxable years beginning in 2026. So January 1st, 2026. So for 25 would have been the last year. It was suspended briefly for a couple of years, part of the CARES Act. And then it was extended as part of the ARPA legislation, which came in early this year, the American Rescue Plan Act. It's hard keeping all these acronyms straight with so much legislation has been passed. But it was extended 1 year to 2027. So, but what the Green Book would do, the Green Book again is a Treasury summary of Biden's proposals. It talks about extending this and making it permanent. So this would become a permanent limitation. Certainly a thorn in the sides of real estate professionals with losses, because it does limit you to that 500,000 number for married filing jointly. So again, this would just be made permanent. More of the same, continues present law in perpetuity.
Okay, thank you, Dan. Next topic we're going to talk about is carried interest. And I believe we have a polling question, Alex. All right, so your question is, for those of you that are on Menti and want to respond, were you impacted by the changes made to carried interest by the Tax Cuts and Jobs Act? And, the carried interest provisions are applicable not only to real estate, very applicable in the financial services industry as well. So we have a mix of potential impact. So Brian, you want to tell us a little bit, maybe do a little bit of history on the carried interest and what it means going forward if the provisions prevail. I think you're on mute, Brian.
Yeah, I realized I started muting myself when my headset yelled at me that I was muted. So yeah, I'll do a little bit of history just to make sure, because that looked like a pretty diverse response to the polls. So the target interest, the targeting of the carried interest loophole has been out there for years. It's been talked about probably forever. The idea of a carried interest, really, imagine you have a fund. The fund raises capital of $100 million. Takes that capital, it deploys it, buys investments, And 2 years later, it receives, it sells those investments for $150 million. So it recognizes a $50 million carried or capital gain. Now, traditionally, the manager of that fund would be compensated with not just a management fee, an annual management fee, you know, common terms say 2% management fee and a 20% carried interest, right? So the manager gets a 2% management fee. That's ordinary income to them. It's a deduction to the partnership for their services in managing the partnership. But also, in addition to that 2% management fee, they're given a 20% carried interest. So at the back end, when there's a liquidation event, they're then compensated additionally for their services over and above that management fee with a 20% carried interest. And so let's assume that that manager is then allocated $10 million, 20% of that $50 million gain. Once the partnership, the way partnership law works is if the partnership has a $50 million long-term capital gain because it held those investments for 2 years, right, more than the 1-year holding period that's required for long-term capital gain, then what the manager gets when it's allocated its 20% share is it gets it's a 20% share of that long-term capital gain. They would, under current law, 20% capital gains rate, that's a pretty good deal because if I took a 20% management fee instead, I may get a bigger number, but it's going to be all subject to ordinary rates at the 37%, as Dan just mentioned, with potential to go up to 39.6 in the Biden plan. So I'm much better off as the manager taking a carried interest, waiting a little while to get my money, getting all my money and being able to pay 20% capital gains rates on it. So this has been out there for years. It's talked about over and over and over again. There's been proposed regulations to change how these profits interest, these carried interests are taxed to try to somehow account for the fact that, in effect, it's income earned for the manager's services in managing the partnership, but it's getting taxed as a capital gain, not as ordinary income, not subject to self-employment tax, the same way that manager would be taxed if that manager took a management fee or some kind of compensation for their services at the time. Tax Cuts and Jobs Act of 2017 comes around and it adds a new code section, Section 1061. Again, if you're interested in where to find this stuff in the code, and it applies some special rules to what they define as applicable partnership interests. Those applicable partnership interests are generally profits interests that are received for services in any kind of applicable trade or business. Applicable trade or business for this purpose, we have definition after definition, but that's the raising or returning of capital and investing in or developing specified assets. It's your securities, your commodities, your real estate that's held for rental or for investment. So it's your big real estate funds, your big financial services funds that are investing in, that are raising capital and then using that capital to invest in or develop these specified assets. What Section 1031 does is it says, if you've received a profits interest in exchange for your services in one of these partnerships that are conducting an applicable trade or business, you no longer test for long-term capital gains based on a 1-year holding period. You have to start testing based on a 3-year holding period. So now we have a disconnect, right? The partnership itself continues to say, hey, I sold my assets at greater than 1 year. That's a long-term capital gain to the partnership. But when that long-term capital gain is then allocated to the applicable partnership interest holder, the manager, the person holding the carried interest, they need to be able to look through the partnership and say, well, these assets weren't held for 3 years. As a result, I need to recharacterize this long-term capital gain to short-term capital gain. To avoid spending the next hour talking about these rules, it gets pretty complex. And now there's a lot more disclosure that has to happen when you're allocating based on these applicable partnership interests, these carried interests. 1031, in some people's minds, didn't go far enough. And the reason that it didn't go far enough is twofold. The 3-year holding period is pretty short, especially when you're talking about the real estate industry and real estate funds. It's unlikely that you're going to be investing, buying a piece of property and then flipping out of it in those 3 years. Once you've hit the 3-year mark, long-term is now long-term to everybody, including the carried interest holder. So there was a lot of feeling that maybe 3 years wasn't a long enough holding period. It also didn't reclassify as ordinary income, right? So if you don't meet that 3-year holding period, one of the things that it does is it says reclassify as short-term capital gains. That's a massive win for everyone. Yes, short-term capital gains are still subject to ordinary tax rates, which could be as high as 37% under current law, and not the more beneficial long-term capital gains rate of 20%. But since it's a short-term capital gain, there's two things that that are beneficial as it relates to short-term capital gain versus reclassification as ordinary income. The first is that you can net it with other capital losses. So if you have other capital losses available, if you can generate other capital losses, you are then able to net that short-term capital gain with capital losses and potentially continue to not incur tax on that. The other thing is that short-term capital gains are not subject to self-employment tax. So in the last section, we talked about the gap, the gap in self-employment earnings. This is another way that they said it's not going to be ordinary income. We're not going to reclassify it as ordinary income. We're going to move it to short-term capital gain, and therefore it's not going to be subject to self-employment tax. Again, the two main things, 1030 or 1061 in the real estate context. One is that the holding period was short enough that for many people, if you were impacted by it, you can probably manage your holding period to be longer than 3 years and you'll be okay. The other thing is that it does not impact, or the 1061 does not cover sales under section 1231. Section 1231 is a disposal of a property in the ordinary course that was used in the ordinary course of your trade or business. So if you have a real estate partnership that acquired property, acted as a landlord for a number of years, and then sold that property for a gain, that's a section 1231 gain. Section 1231 gains have separate rules, and they're not taxed as capital gains at the partnership level. So section 1061 did not apply to a real estate partnership's sale of section 1231 property. So again, section 1061 was probably not as impactful on the real estate industry as proponents of doing away with this carried interest loophole would have wanted. The Green Book proposal does a lot more, right? So the Biden proposal right now repeals section 1061 for taxpayers who make more than $400,000 a year. It would be be in place for years beginning after 12/31/2021. So we're starting next year. And since it repeals 1061 for those folks, it gives us a couple new definitions. And it has this idea of an investment services partnership interest, very similar to our applicable partnership interest under 1061. That's a profits interest in an investment partnership that's held by someone who provides services to that partnership. So it's going to hit our managers. Again, the investment partnership is going to be substantially similar to the other one. If all your assets are investment type assets, securities, and real estate, you have an investment partnership. Where this proposal goes is that it reclassifies it taxes as ordinary income, not as short-term capital gain, ordinary income, that partners share from any investment services partnership interest. It's regardless of character at the partnership level. So if the partnership sells an asset after 367 days and reports a long-term capital gain, that doesn't matter. If you hold an investment services partnership interest and your income is over $400,000, you're going to have to recharacterize that as ordinary income. So like we talked about with the short-term capital gains, now it's not eligible for the reduced long-term capital gains rate, but you also can't match it up against other capital losses that you may have. It's ordinary income. The other thing it does is that it would apply self-employment tax. So now you have ordinary income earned from this investment services partnership interest. You're going to be deemed to have to pay the self-employment tax on this as well. So it substantially changes the tax landscape for these carried interest holders. There is, as there is in section 1061, there are carve-outs to allow that, if I'm a manager, but I also co-invest with my limiteds, I have some invested capital into the deal. There are some carve-outs that say any allocations that are made to me on my invested capital are not subject to this recharacterization rule. It would really only be any allocation that is made to me based on my services interest, the profits interest tied to my services. Those rules are going to be complex, I'm sure, as they are under 1061, and it's going to require a lot of looking. But I think for those who may have been impacted by 1061, who have carried interest arrangements or who are contemplating carried interest arrangements, understand that this particular proposal would whipsaw back in to those all being recharacterized as ordinary income, not as short-term capital gains. And then really for the real estate folks on the call, the carve out for section 1231 transactions that exists in section 1061, there does not appear to be anything in the Biden proposal that would allow gains from the sale of property used in a trade or business to be excluded from this recharacterization. So if you have this taxable income over $400,000 and you're allocated on a carried interest, and some of that allocation is capital gain or 1231 gain tied to a disposal of a piece of property, it would seem, based on the limited guidance that's available in the Green Book, that all of that income would be subject to recharacterization as ordinary income under this proposal. The revenue raises on this one aren't as substantial. I think over 5 years, it's about 650 million, and after 10 years, it's maybe a 1.5 billion. So this is one of the smaller revenue raisers that we've talked about. But if I had to handicap it, I know this is one area that there seems to always be a target hanging around. And, 1061, I think, went, where no one has been willing to go before and actually change a little something. But I think in some circles, there is a feeling that 1061 did not go far enough, and that more needs to happen now to put those carried interest holders on the same footing as other people who, receive partnership interest for their services, and let that be taxed as ordinary income, the compensation for the services that they provide.
Right. You could argue too, probably, that the Democrats are more against the provision than the Republicans.
Yeah.
Despite the Republicans, pushed through 1061, it was very limited. It had somewhat limited effect because, private equity holds their investments much longer than 3 years.
Most everything does, right?
So if they're going to, and hedge holds it less than a year, so it wasn't an issue. It didn't affect hedge. It likely didn't affect private equity.
Right.
So the Democrats don't care about this, and I think there was a proposal by some Democratic House members to get at this recently, a year or two ago.
Yeah, I think was it Bill Pascarell in the House and Hirono
so,
in the
yeah.
Senate or something that proposed a law, and my understanding is that the proposal of the proposal Biden put out kind of tailored to their law. Their law is pretty complex. The law proposal that they put out was pretty complex, so I think it's just going to make this more complex than it already is, and I would imagine, yeah, there's going to be a lot of drumbeat in this particular area.
Yeah.
And it always seems to be a topic of conversation over the years. So we will see what happens. So we do have one more topic to talk about. Again, if you have any questions, please feel free to type them into the chat, and I'll direct them to Dan or to Brian. Or you're welcome to raise your hand, and I will call on you as well. So, but Dan's going to talk about our last topic, which is step-ups.
Great. So step up in basis, this is a huge issue. I do want to preface this discussion with a brief story that this topic was discussed at the Heckerling Estate Tax Planning Conference, which is the annual conference for estate planners. The consensus was that there's almost no chance this will pass. So having said that, let me talk about the proposal. What they're talking about here is eliminating the possibility of excluding capital gain upon death. So as Brian mentioned before, people who do 1031s, they borrow against their appreciated assets. They do anything they can to avoid recognizing gain, because when they pass away, that gain disappears on death. The relatives get the beneficiaries get a step up in basis, and the step up in basis comes at no cost. So this type of planning has been going on for years. The Estee Lauder family that's founded Estee Lauder, the Lauders, they did a transaction back in the 90s where they to avoid gain, and they passed a separate section 1259 to get at that. So they've been trying to eat away at this and chew away at it for a while now. So what it does is it would require that appreciated assets are recognized, gain is recognized when someone passes away. The very small mitigating factors are that they can use any capital losses in that year of death, or any carryovers from prior years can offset the gain. And also the taxes can be deducted on an estate tax return, minor offsets, but to a very big walloping tax hit here. There are exemptions there would be exemptions, I should say, in the proposal for transfers to surviving spouses and to charities. And it would also, another exemption would be gains on tangible personal property. So I think furniture, clothing, et cetera, but not collectibles. So if you had collectibles, stamps, coins, that kind of thing, those would be subject to tax. The current exclusions are $1 million per person. They're portable, so spouses can get a $2 million exemption. Also, the gain on the sale of residence, $250 per person, $500 per married filing jointly. That would also apply. So minimal exclusions here. The last thing I'll mention about it, if it goes through, is the biggest lobby against this is family-owned businesses. The complaint is that if you had a family-owned and operated business, they would have to sell the business in order to pay the tax, and which would lead to the loss of jobs, and the whole slippery slope of the economy will come crashing down because they have to sell the business. Never mind that they can sell it to someone who's operating it and continues operating it. There doesn't need to be any loss in jobs, but that's the argument. So there was an exception for family-owned and operated businesses. So the tax on, it's a defined term, but the tax would not be due until those businesses were sold or it ceased to be family-owned and operated. So, for example, a private equity firm buys in for a significant part of the business. That's when the tax would be due. So there's somewhat of a delayed payment mechanism to mitigate the harsh effects on people like family-owned businesses. The last thing is that for other illiquid assets that are not cannot easily be sold, they would allow for a 15-year fixed payment plan. So again, another way to mitigate against the effects of this would be to allow a 15-year payment plan to pay the tax that's triggered upon death. So very significant change in law, not likely to pass, but if it does, it would obviously have a great impact on a lot of existing tax planning.
Thank you, Dan. So that concludes the topics that we wanted to share with you today. We really thank you for joining us. I don't see any questions in the chat, so I'm going to interpret that as Brian and Dan, you did a fantastic job and you explained everything really, really well.
Must be the case.
And really made it so that we could all understand it. So, but we're absolutely happy to have all of you join us today. We are going to continue to have these roundtables either monthly or every other month going forward. So please stay tuned for the invitations. If you have any questions in the meantime for Brian or Dan or myself or anything I can push to either one of them, please let me know. Or Alex, who you all received emails and the invites from. But again, thank you for joining us today, and we look forward to seeing you soon. Take care, everyone. Bye-bye.
Bye.
Thank you, everyone.